Hey everyone, welcome to This Explainer. Today, we're diving into what I'd honestly call a masterclass in corporate resilience. We're breaking down A.O. Smith's second quarter 2026 earnings, and let me tell you, it's a fascinating look at how a global water technology giant navigates some seriously complex global crosscurrents. If you've been wanting to see exactly how a massive manufacturing company balances booming domestic success against some pretty heavy international headwinds, well, you're in exactly the right place.
So think of A.O. Smith right now as a massive ship out in some really choppy waters, which, is a pretty fitting metaphor for a global water heating company. Right now, this ship is riding high on some powerful positive waves in certain areas, but it's simultaneously battling deep, pulling undercurrents in others. How they're actually managing to stay afloat and, spoiler alert, generate a ton of cash in the process is a story we really need to unpack.
Okay, let's dive into this. Here is our roadmap for today. First, the billion-dollar balancing act. Then, North America, boilers run hot. After that, China headwinds challenge growth. Next, cash flow and capital returns. And finally, the 2026 outlook. Kicking things off with Section 1, the billion-dollar balancing act, focusing on our Q2 2026 top-line results. Now, if you were just skimming the headlines, you might actually think this was a pretty uneventful quarter. Total sales came in at a flat $1 billion. That's down just a tiny 1% year over year. Adjusted earnings per share sat at $1.03, which is a 4% dip. And net earnings landed at a solid $125 million. So at first glance, kind of looks like a stable, maybe even slightly boring quarter. But as you'll see, the real story is hidden right beneath the surface of those consolidated numbers. Because here's where it gets interesting. We basically have two completely different realities happening at the exact same time. On one hand, the North American segment saw sales increase 5% over $820 million. But then look at the rest of world segment. Sales absolutely cratered by 19%, dropping down to around $195 million. This split right here, this is the core tension we're looking at today. You've got a booming domestic market acting as a heavy counterweight to a really struggling international one. Moving on to Section 2, North America, boilers run hot, where we look at them riding the domestic wave. 21%. Keep that massive number in your head for a second. North American boiler sales didn't just grow, they rocketed up 21% this quarter. This was driven by a really powerful combination of higher volumes and some strategic pricing benefits. And this surge was literally the engine that drove the entire segment to a 3% organic growth rate. That momentum completely offset the softness they were seeing in the standard residential water heater market. But hey, it wasn't just organic growth keeping things moving smoothly. The recent acquisition of Leonard Valve immediately proved its worth, adding $16 million in top-line sales. Meanwhile, management executed some really smart carryover pricing actions, basically reaping the benefits of past price hikes to protect revenue against that softer residential demand we just talked about. And why is this so crucial? Because they were dealing with a brutal 20% spike in steel costs. Let that sink in. To absorb a 20% increase in a primary raw material like steel and only see your adjusted segment margin dip slightly to 24.4%, that is a huge testament to their incredible pricing power and operational discipline. All right, Section 3. China headwinds challenge growth. The international undercurrent. Now, what's really interesting about the rest of world segment is the sheer scale of the drop. Revenue fell from $240 million in Q2 of 2025 all the way down to just $195 million this quarter. That is a 19% drop overall. But it's almost entirely tied to a single incredibly powerful factor that the company is grappling with right now. Yep, that factor is China. If you strip away currency translations and just look at the local currency, sales in China plummeted by a staggering 28%. The data makes it super clear. This is driven by a persistently weak consumer appliance market and a generally challenging economic environment over there. This undercurrent was so strong it severely dragged down profitability, compressing the segment margin from a healthy 10.5% last year down to just 5.2% this quarter. It's definitely a harsh reminder of the volatility you get with global markets. Next up, Section 4, Cash Flow and Capital Returns, flooding the balance sheet. $254 million. That is their operating cash flow for just the first half of the year. So despite the earnings dip we just saw due to China, this cash flow number represents a massive 42% increase year over year. And honestly, the hits keep coming. Free cash flow, so the actual cash left over after capital expenditures, came in at $233 million.
That's up an unbelievable 67% from the prior year. So you're probably wondering, how on earth do you grow cash flow by 67% when net earnings are actually down? Well, the secret sauce is their working capital management. Management was incredibly disciplined with how they tied up their cash in day-to-day operations, things like inventory and receivables. They optimized their balance sheet to squeeze out maximum liquidity, entirely defying that international profit drag. So, what does this all mean for us? Well, these immense ebbs and flows in cash directly benefit the shareholders. Because they're generating so much free cash, A.O. Smith has already repurchased 2.6 million shares for over $162 million this year. Even better, management is so confident in their cash generation that they went ahead and boosted their full year's share repurchase target by a massive 50%, aiming for $300 million. You add that to a declared quarterly cash dividend of 36 cents per share, which, by the way, continues a streak of over 30 consecutive years of dividend hikes, and you've got a company highly committed to returning value no matter what the economic weather looks like.
Bringing us to our final section, Section 5, the 2026 Outlook. Narrowing the forecast.
For the rest of the year, management has actually slightly narrowed their forecast. Because of that ongoing softness in residential water heater demand, they tightened expected sales growth to a range of 2% to 3% and adjusted EPS to between $3.70 and $3.85. But even with that tightening, they are still projecting a massive free cash flow of around $525 to $575 million for the year. So the ship's speed might be slightly adjusted, but the engines, they are still generating incredible power.
And they certainly aren't just sitting still. They are proactively patching the hole to stay resilient. For example, this quarter included a $22.6 million restructuring charge in their North American water treatment business. Sure, it hurts the GAAP earnings today, but it's a very strategic move to optimize their footprint and rationalize brands. They expect this to generate $6 million to $8 million in annual savings starting in 2027. It really proves that management is constantly looking ahead to secure long-term profitability.
Which leaves us with this defining question. Can A.O. Smith's incredible North American strength and pricing power continue to outpace the fierce global headwinds originating in China? They've proven they can generate immense cash flow even when parts of the business are struggling. But as the rest of 2026 unfolds, watching how these two very different market currents collide is going to be the ultimate test of their corporate resilience. Thank you so much for joining me for this explainer. Keep an eye on those cash flows and keep learning.